Good afternoon, everyone. Thanks for tuning into this month's SignatureFD investment webcast, Cutting Through the Noise. I'm Tony Welch, Chief Investment Officer here at SignatureFD. Now, a little about us for those listening in for the first time. We are a 100% independently owned registered investment advisor. We were established in 1997. We have offices in Atlanta and Charlotte. And we are fortunate enough to have been entrusted to manage over $6 billion for our clients. You can find more information at SignatureFD.com. Now, as for today's investment content, here's what's on our agenda. Now, in Q1, the market continued to build on a rally that began in October in Q4 of last year. And we think it's notable that despite the better market conditions that we've seen, sentiment towards the economy, earnings, and share prices remains pessimistic. Now, on the economy, we're going to talk about why economists continue to forecast recession and what is potentially confounding those expectations. And then we'll touch on portfolio strategy. Some combination of better earnings expectations and or a lower interest rate that could help drive share prices higher from here. We're going to spend a little bit of time as well on the bond market. We've gotten a lot of questions there. So let's start with a look in the rear view. Now, in 2022, commodities and the dollar were strong, while bonds and stocks had a very tough year. Now, in Q1, those trends largely reversed. Stocks and bonds were higher, while the dollar and commodities weakened. Now, we intake a lot of research, and I can pretty confidently say that the reversal that we saw from 2022 to Q1 was contrary to most expectations heading into the year. But what's sentiment looking like now? So here's a sample, but nearly everything that we look at, every other sentiment gauge that we see, tells a similar story to this chart here. This chart shows fund manager positioning towards the end of March. Now note that they were highly overweight bonds, consumer staples, and cash. Now, consumer staple stocks, that tends to be one of the most defensive sectors. Now, look at the bottom of this chart. You can see that these fund managers were underweight U.S. stocks, particularly technology stocks. Now, in the interest of brevity, I didn't include charts in this presentation on the economy or earnings sentiment, but the picture is largely the same as it is with the market sentiment. There's seemingly a lot of pessimism embedded, which almost definitionally means that it's easier to surprise to the upside. Now, the timing of today's webcast is good because we actually got the first estimate of Q1 economic growth today in the form of gross domestic product. It looks like the economy grew. It grew at a slow but positive rate, and it was driven by a surge in consumer spending. Now, a continuation of positive economic growth, that's been confounding the consensus for a while now, and for good reason. In red in the bottom clip of this chart, it shows the year-to-year change in what we would call leading economic indicators. These are things like the yield curve, stock prices, housing starts, and economic sentiment. Now, leading indicators have been consistent with an imminent recession since as early as March of last year. But we suspect that the leading indicators could be leading by an inordinate amount of time in this cycle. The economy has two major moats that are lending support to consumer spending. The first is excess savings that were built through the pandemic stimulus programs. The second is the job market, which remains tight. So here in this chart, we're showing the so-called jobs gap, which is the difference between job openings and the number of workers in the economy. And what we've circled here, I would note that it's been falling, but it remains well above any other historical levels since at least 1950. Each of these major moats, excess savings and the jobs gap, have time before they're back to pre-pandemic levels. And that could be the driver that supports consumption from here. Now, does that mean that the Fed is going to pull off this so-called soft landing? Well, according to BCA research, it may look and feel a lot like a soft landing for much of the rest of this year, maybe into 2024. That narrowing jobs gap could continue to take pressure off of inflation while economic growth remains positive. However, eventually, those big economic moats will fully run their course and normalize, and we could be left with tight credit conditions and a very high real Fed funds rate. Now, this chart here shows the change in loans outstanding from banks. Now, what we can see is that large banks have still been making loans, but small banks have essentially frozen in their lending activity. Tight credit conditions and restrictive interest rates are likely to push the economy into a recession eventually. We just think that the consensus timing on that recession start date is way off. Now let's turn more specifically to the market. Large cap US stocks are right around their historic valuation level. So what could give us some upside from here if stocks are really only just fairly valued? Well, two things. These two charts illustrate the two important drivers of share prices. Now, on the left, this is showing the 1 year change in forward earnings expectations on the vertical axis, that y-axis. The horizontal, or the x-axis, is showing the 1 year change in stock prices. It's very clear that there is a linear relationship between stock prices and earnings expectations. As expectations move higher, so do share prices, with a bit of a leading tendency, of course. Now, the chart on the right shows the relationship between stock market valuations and interest rates. Now, valuation is plotted on the vertical axis, the y-axis, and interest rates are plotted on the x-axis, the horizontal axis. Now, what's evident here is that the stock market valuations have more of an exponential relationship with interest rates. In other words, when rates fall, valuation tends to move higher, and it can often move meaningfully higher. So some combination of better earnings expectations and or lower interest rates could help propel share prices higher from here. Now, more granularly, we entered the year expecting to add to value opportunities in client portfolios. Here's a table showing the 11 sectors and their level of valuation relative to the market. Readings below 1 mean that the sector is trading at a valuation that's cheaper than the market itself. Now we can see that the 3 sectors trading at a discount are energy, materials, and financials. These are what we would consider cyclical value sectors because they have a high sensitivity to the economy and economic growth. Now we see opportunity there, but timing has not been right thus far. The top clip in this chart in blue shows growth stocks versus value stocks over time. When the line is moving higher, it means growth is outperforming, and when it's moving lower, it means value investing has the upper hand. Now the bottom clip shows the 1 year change in economic growth. What's notable is that the value sectors tend to outperform growth sectors when economic growth is strong and strengthening. Now, growth tends to do better than value stocks when economic growth is soft or softening. Well, right now, economic growth is neither hot nor cold, and that environment has argued for a balanced approach to portfolios. And that's why our portfolio allocation is very neutral right now. So let's spend a little bit of time on bonds. We've gotten some very good questions on bond allocation and what should we be doing when short-term bond yields are higher than longer-term bonds. Here in this chart, we can see that as of last week, the 10-year Treasury was at about 3.6%, while 3-month T-bills were at 5%. In the bottom of the chart here, there are some statistics around how stocks, bonds, and cash perform under this condition. So let's zoom in on that. On average, we can see that it often makes sense to shorten up your duration in your bond portfolio when you can get those higher rates on cash than you can get on longer-term bonds. And that's exactly what played out in 2022. Unfortunately, the market doesn't make it that easy on us around the turning points, though. We think that we're nearing the end of the Fed's tightening campaign. So what could that mean for our bond allocations? Well, that means that we think short-term Fed-controlled rates will be reaching their peak soon. Here's a chart that shows what has occurred on average in 3 different investments in the subsequent 1, 3, and 5 years after CD rates hit their highest level. The purple bars are 1-year CDs, a proxy for cash. The blue bars are short-term bonds that carry a little more rate sensitivity than those CDs. And the aqua bars are intermediate-term bonds. And what we can see is a pattern of longer duration bonds outperforming shorter term bonds following that peak rate in CD rates. So what investment nerds might say about this is that duration risk was the dominant risk for bonds last year, but now it's reinvestment risk that's coming to the forefront. In other words, the greater risk may be that you cannot roll your near-term debt into rates at or a better level than you could before. So this argues for a pretty balanced view within the bond portfolio as well. Finally, I got a few pre-questions heading into this presentation today on the debt ceiling. And that's especially relevant as the House passed their proposal last night. And I do think it's important to touch on it as it's becoming more front and center. Now, BCA Research, they project that the Treasury's general account could run out by June, and that would accelerate the debt ceiling debate. It's notable that T-bill investors have seemingly already begun to change their behavior. This chart here shows the yield on 1-month, 3-month, and 6-month T-bills. Note that the yield on 1-month bills has plunged relative to those other maturities. That's likely because investors are willing to take less yield for the security of the bills that are expiring before this so-called X date on the debt ceiling. Anything the market is taking seriously, we certainly would take seriously as well. Now, we don't have any particular political insight into whether or not Congress will eventually arrive at a deal, although the political strategy research that we do receive has tended to believe that something will get done. The probability of a true default is something in the 5% range. The House plan, that's not going to pass, but it is an important step in beginning the negotiations. We do, however, have transcripts from 2011's plan that should a deal not have been passed back then, the plan had included prioritizing debt payments over other spending, and there's no reason to believe that wouldn't be the plan this time around. So what that would mean is that bondholders should be fine, but this could create a large fiscal drag, which would potentially result in lower yields and potentially a correction in share prices. The other thing that we look for is potential austerity measures. So even if we get the debt ceiling passed, and it's passed on much more austerity and less fiscal spending, that could also impact both economic growth long term, and it could impact certain sectors that derive revenue from government spending. So we'll have more to report on the debt ceiling as we start to see what the deal looks like and the ramifications of that. Now, to recap, sentiment remains extremely dour. Remember that markets do tend to climb a wall of worry, and that does still exist today. Economic growth may confound the downbeat expectations, but eventually there will be a recession, just potentially later than the consensus estimates. Now, stocks are right around fair value, so what could drive them higher from here? Well, that would be some combination of higher earnings expectations and lower interest rates, and both of those are possible. Now, for bonds, we think it's important to recognize that duration risk, that was the dominant risk in 2022, but that may soon shift to reinvestment risk being the dominant risk for the rest of this year and into 2024. Okay, so here are important disclosures, and let me take a look at the questions dialogue to see if anything came in for this month's update. Okay, folks, there are no questions this month. We'll go ahead and wrap it up. And I want to thank everybody for spending some time with us on their Thursday afternoon.